Hello, my name is Steve Bigelow. I've got over 35 years of investment experience, 8 of them with major Wall Street firms. But more importantly, the last 25 years has been oriented toward candlestick analysis. The most important contributions the Japanese rice traders provided for us as investors was over the last 400 years, they discovered which signals and where signals occurred to show us early warnings for reversals. So this training session is going to be oriented toward the doji. The doji is probably one of the most well-known and probably the most information-packed signal of all the major signals. Let's do a quick review of the basics. Candlestick signals are based upon the open and closes. Japanese rice traders showed us that if it opened here and closed above where it opened, it created a bullish candle, a white candle. If it opened here and closed below where it opened, it created a dark candle. That did not necessarily mean that there was the price of whatever trading entity was up or down for the day. In this training session, I will use the term stock to include all trading entities. And the doji has different characteristics. Over the years, I've discovered out of the 50 or 60 signals, there's only 12 that you really need to learn. We're going to concentrate on the doji in this training. What are we always looking for? We're always looking for the trades that are going to provide big gains. This training will show us how a doji is usually a very informational element of where investor sentiment is changing and that we start taking advantage of a new price trend. Most promoters or most investor promoting a trading technique like to show you their big moves that they took advantage of. We're not concerned with the big moves and an afterthought. We're interested in what occurred before the big move that got us into that position. The unique characteristic of a doji is that it opens and closes right at the same level, creating a doji star. Now, if the price magnitude is very big during the day and it closes at the same level, it's called a long-legged doji. Opens at the top of the trading range, trades down most of the day and closes right back up at the top of the trading range, called a dragonfly doji because it looks like a dragonfly. Or the Japanese rice traders say they open, the warriors come out of camp, go into battle, and by the end of the day they're beaten back into their camp, leaving their dead all over the field, thus the gravestone doji. The spinning top is a derivative of the doji, but it has a little bit bigger body. But it still shows the same thing that all dojis show, indecision between the bulls and the bears. Call it a spinning top because it kind of looks like a spinning top. And there are some very simple rules that the Japanese rice traders told us to apply to a doji. When you see a doji at the top, it's time to sell. If you see a doji at the bottom, the price needs to have bullish confirmation, or the Japanese say the weight of the market could continue to push the market down. They always say to pay heed whenever a doji appears, because that means there's indecision going on between the bulls and the bears. But the most important aspect of the doji is that the trend will usually move in the direction of how they open it the next day after a doji. That is where you're going to make a lot of money knowing that simple rule. Now, I also say the next day, candlestick signals work very effectively on the 1-minute chart, the 5-minute chart, or the 15-minute chart, just as effectively as they will work on a daily chart, weekly chart, or a monthly chart. Each chart is developed by the accumulative knowledge of everybody that is buying and selling during that time frame. If you remember that one statement, you will see how the power of candlestick signals will work very profitably for you. Before we start, let's go through a few chart indicators that make candlestick signals more effectively that will be showing up on most of the charts in this demonstration, and it will give you a little bit more idea where the signals work effectively and why they work effectively at those levels. As you will notice, the charts are fairly simple. What we have on the charts, starting down here, is we use stochastics of 1233 to indicate whether we're in an overbought or oversold condition. Logic says that if you see a candlestick buy signal in an oversold condition, you've got an extremely high probability you're going to start seeing an uptrend. Or if you see a candlestick sell signal in an overbought condition, you've got a very high probability you're going to see a downtrend. Now, the indicators we use on our chart is the big red line, which is very hard to see on this chart, is a 200-day moving average, simple moving average. The blue line is the 50-day simple moving average. The gray line is the 20 simple moving average. The reason we have these on our charts is all the money managers around the world use these simple moving averages to make their decisions based upon very large investment trade decisions. The advantage we have with candlestick analysis is that we can see immediately what investor sentiment is doing at those technical levels. So moving averages act very much like magnets. There'll be a lot of decision making going on at those levels. Now, we also have what we call the T line. This is the 8 exponential moving average, and it's very effective for telling us if we see a candlestick buy signal and a close above the T line, the trend will stay in progress until we see a candlestick sell signal and a close below the T line. At that point, you're in a downtrend until you see a candlestick buy signal and a close back up above the T line. The T line is a very important factor, especially when you're trading candlesticks, no matter whether you're on the 1-minute chart, the 5-minute chart, or 15-minute chart, or on the daily, weekly, or monthly chart. We will start with this training with the doji at the top. The Japanese rice traders created a very strong visual element to see where investor sentiment was changing. Graphically, we can see on candlestick charts where most people sell. They panic sell at the bottom, or they exuberantly buy at the top. When we start seeing exuberance in the overbought area, and then see a candlestick sell signal, such as a doji, that tells us it's time to start looking for a reversal of investor sentiment. A doji at the top has one good confirmation. If it opens lower the next day, the sellers are in control. You want to close out the position immediately. Witnessing a gap up in the overbought condition also tells you to start watching for a sell signal. A gap up doji is a very good indication that the bulls and the bears have finally come to an equilibrium. If they open it lower the next day, it's time to take profits immediately. A doji in the overbought area, it's time to watch to see if it's time to take profits. One thing you're going to see in this training process is a lot of repetition. There's no formulas that you have to know about candlestick analysis. It's merely identifying the visual areas where a signal has occurred and what type of signal has occurred. Again, if you're in a steady uptrend and you see a gap up in an overbought condition, and it forms into a doji, that tells you the bulls and the bears have finally reached an equilibrium. This is a place where you want to at least start taking profits. The problem that most investors have is they're afraid to close out of a position because what's their biggest fear? That after making a good profit, this could still keep right on going up. However, candlestick signals show you that this is a high probability situation where you should be taking profits or getting out of the position. So the worst case scenario is take off half your position. If it continues higher, you're still making half your profits after making hopefully a good profit on the full position until you got up into a high risk situation where you're in an overbought area and you're starting to see exuberant buying. If it continues up, you're at least making money off half that remaining position. If it opens lower the next day, you close out the position completely. At least your average selling price is somewhere in here. Candlestick analysis is not trying to buy at the absolute bottom and sell at the absolute top. We're trying to catch that fat part in the middle, the high probability area, take profits when it's time to take profits, and move into another chart where the probabilities are in your favor, that you've got a lot of upside potential. When you start seeing multiple dojis in an overbought condition, start taking profits, especially if you see them open it lower the next day. And witnessing a doji up in the overbought area followed by a gap down or lower price and heading down basically tells you the sellers are now in control, especially if they can close below the T-line. You will find that the T-line is a very effective tool, that if you see a candlestick sell signal and a close below the T-line, you stay short if you go short until you see a candlestick buy signal and a close back up above the T-line. This is nothing that is created by rocket scientists. This is just merely simple observations that the Japanese rice traders have made for the last few hundred years based upon investor sentiment, with the capabilities now of putting on moving averages, computer generated indicators that work very well in conjunction with each other. Witnessing gap ups and dojis in an overbought condition should be an alert that there's now some exuberance coming into this price trend. It's about time to get ready to take some profits. And as you will see with a lot of candlestick signals, they don't necessarily have to be one. They can start to be a series of indecisions up here that show that the bulls and the bears are in a battle. The longer this battle persists, usually the more decisive the next trend is going to be. With a case of a doji, bullish day, doji, all happening in an overbought condition, this signal right here, a bearish engulfing signal, following a doji, gives us a very strong sell signal. This is known as the left-right combination, which we'll get to here a little bit further in the training. A left-right combination after a series of indecisive trading in an overbought condition. What we're looking for when we're using candlestick analysis is to put all the probabilities in our favor. When we see indicators that start aligning with as many reasons to see a reversal, indecisive trading, a bearish engulfing signal, stochastic starting to roll over, and a close back below the T-line, this all is an indication that the uptrend is over and a very high probability you're going to be in a strong downtrend. Spinning top, doji, bearish confirmation closing below the T-line, stochastics rolling over. This is a good indication that our uptrend is over. Our downtrend is about ready to start. And here's another little tidbit about our T-line. T-line is going to be very effective for showing you when an uptrend is in progress. But another aspect of the T-line is the further you move away from the T-line, the higher the probability it's going to come back and test the T-line. So if we're seeing a nice strong uptrend, start seeing some strong buying and a doji, the probabilities are pretty strong. They're going to at least come back down and test the T-line. So if we can see that this is a sell confirmation, we think it could come back and down and test the T-line, but why take the risk? You can always close out the position, and if it comes down and bounces back up off the T-line, you can always buy back, creating what we would call a J-hook pattern, which we'll get into later. But we're not guaranteed that it's going to hold the T-line. Could have a situation like this. Most investors give a lot of their profits back to see confirmation that the selling has occurred. Candlestick analysis has very simple rules for each indicator to tell you when the investor sentiment has changed. Doji in the overbought condition, away from the T-line, opening lower the next day, take profits. A gap up shooting star. Anytime you see a gap up in an overbought condition, start looking for candlestick sell signals. Shooting star, a doji, followed by a bearish engulfing signal. Now we have, a few days later, another doji. Remember our simple rule of a doji. The price is going to move in the direction of how they open it after a doji. Here we have a doji that could be setting up and showing us we might be in a J-hook pattern, which would be a strong price move, a pullback, and a next wave up if it was bouncing off the T-line. However, the doji shows us they've opened it lower and started heading this way below the T-line, more confirmation that the bears are in control and could start a strong downtrend. Again, a long-legged doji represents more indecision. Came all the way back to the T-line, bounced back up, but the next day they opened it lower and started taking it right back down again. Stochastic slowly moving back down. High probability it's time to take profits. Over here, we have a situation where they could be bringing it back up strong, but notice what they did. A long-legged doji that closed back below the T-line, and the next day they opened it lower. This further confirmed that our downtrend was in progress. Dojis at the top. What are we looking for? A lower open. Bearish confirmation, or confirmation the bulls are out of the way. The bears are starting to take control. This is where you want to be taking profits. An extremely high probability situation that if they open it lower in the overbought condition, the bears are in control. The worst case scenario is you take profits, and if it came back up through the doji, you can always buy back in. Remember, we're not trying to make every penny from this uptrend. We're trying to make the high probability fat part profit of that uptrend. So candlestick analysis makes the doji a very simple indicator or signal to use. It represents indecision. And if you see the next day they're gapping it down, that tells you a very clear picture, a very clear story. That after a day of indecision, they're showing you with much decisiveness which direction they want to move the trend. Which means if you see a doji in the overbought condition and they're gapping it down the next day, you want to be out of that position. And remember, when you start seeing prices gap up in the overbought condition, may not do a sell signal immediately, but start watching for a sell signal. A doji, harami, and we'll get to the haramis later, tells us the buying has stopped. The next day they gap it down, you want to be out of this position immediately. Not only did they tell you there was indecision up here, but they told you with very clear decisiveness which direction they wanted to move the trend after that. It was very easy to see that the sellers wanted out of this position rapidly. And it's not too hard to make a conjecture that if you see a doji with a huge gap down, that there is something wrong after that day of indecision. There's the probabilities that this is not a good long trade anymore is extremely high. Get out of the position immediately. The more elements you put where the probabilities are in your favor, the better off the trade is going to be as far as a correct trade. Uptrend, 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 right here on the 200-day moving average. Stochastics in the overbought condition. A doji, they open it lower. That tells you exactly what they're doing here at the 200. They're taking their profits. And with a gap down, not only are they taking profits, but they're very anxious to get in or get from long to short. So you stay short as long as you don't see a candlestick buy signal and a close up above the T line. Very important factor about the doji. Notice it's sitting right here on the T line. We know that we have one simple rule about the doji. Prices are going to move in the direction of how they open the next day after a doji. A positive open would produce high probabilities that you're in an uptrend. So you'd have a candlestick buy signal and a close above the T line. That was time to get out of your short positions. The fact that they opened it lower told you the exact same thing. They're going to move it in the direction of how they open after a doji, which meant your downtrend was still in progress. Anytime you see the doji at an important technical level that open the next day is going to give you a lot of information on which way they are moving it off that technical level. A doji shooting star, a good distance away from the T line, tells you there's a probability they're going to take it back down to the T line. We don't know whether they're going to take it to the T line and support or just keep right on going. Get out of the trade, take your profits. You can always buy back in based upon the next candlestick buy signal and confirmation. Or if you see indecisive trading at a major resistance level, stochastics telling us we're overbought. When we hit this level, that much more probability that you see a doji and a lower open that they're taking it back down. If the 200-day moving average was not acting as resistance, we wouldn't see indecisive trading here. We could see that the 200-day moving average had been breached and they're continuing the uptrend. The more compelling your signal at an overbought condition, such as a long-legged doji, gives us valuable information. The next day they open it lower, that tells you which direction they're probably taking it. In this case, taking it back down to the 50-day moving average. Take profits because that's what the probabilities of 400 years of Japanese rice traders observing human behavior and put it into a graphic depiction is illustrating for us. To review doji rule number 1, if you see a doji at the top, start taking profits. Once again, our top is when the stochastics are in an overbought condition and you see a doji at the top of the trend. That's usually where the bulls and the bears have reached equilibrium. Dojis at the bottom have a different confirmation. If you see a doji in the oversold condition, the Japanese rice traders say you need to see bullish confirmation the next day, or the weight of the market could continue to push the market down. Again, simple logic says if you see a candlestick reversal signal in an oversold condition, the probabilities are extremely strong that if they confirm it, you're in an uptrend. That's exactly what a doji needs in an oversold condition. If you see a doji, start watching to see if they open up positive the next day. What makes this a very simple trade is if they open up positive, the probabilities are extremely high they're going to take it higher. The worst case scenario is they're going to come back up and test the T-line, and if they fail, you'll see that by some sort of indecisive trading that starts backing off. At least you can get out with a small profit or at least break even. On the other hand, the doji has a very simple stop loss process that if it opens positive, that tells us the probabilities are extremely strong we should be in an uptrend, so there's one spot that we should not see any trading, and that's back down below the doji. That if it comes back down through there, that tells us the sellers are still in control, which they shouldn't be. The reversal should have occurred. The doji in the oversold area followed by bullish confirmation provides high probability you're in an uptrend. Now the final confirmation is, can they close it above the T-line? Had they come up here and started fading, then you get back out of the position, hopefully at a break even. Remember, most money managers give you the sage advice of cut your losses short and let your profits run. But they never tell you how to cut your losses short and let your profits run. Candlestick analysis makes it very simple. The charts tell you who's in control, the bulls or the bears. So what becomes even more compelling is what we know about investor sentiment. Where do most people sell? They panic sell at the bottom. So if you see a gap down in an oversold condition and see a candlestick reversal signal, start watching for the reversal. A doji, they open up positive the next day but bring it back down. Doesn't necessarily mean they didn't confirm. It took another day to confirm it and start the uptrend. Notice that we have a doji harami. And we'll get to the haramis later in these trainings videos. But a harami tells you that the selling has stopped. Now, that could occur with just a little inside day. However, whenever you see a multiple signal, such as a harami or an evening star or morning star signal that involves a doji, it's a little bit more compelling that the trend is now ready to move in the opposite direction. A doji, a spinning top, and then bullish confirmation that takes us back up above the T-line, stochastics coming up, are all elements to show that there's been a change of investor sentiment, that we should be now starting in an uptrend. Oversold conditions, doji, a bullish day that takes us up above the T-line. We can stay in this trend as long as we don't see a candlestick sell signal and a close back below the T-line. Anytime you see a doji in oversold conditions, start watching for the buy confirmation. The nice aspect about candlestick analysis is it's all visual. If we detect dojis as being an indecisive trading day in an area that is oversold, then we start seeing that the indecisiveness means there's probably going to be a change of investor sentiment soon. Very simple confirmation is a bullish day after a doji. A bullish day after a doji closing above the T-line. Stochastics starting to come back up out of the oversold area. Once again, as many elements as we could add to our analysis that tells us there's been a change of investor sentiment, the higher the probability we're going to be in the correct trade at the correct time. Using the candlesticks with the gaps provides very powerful indications of which direction the trend is going to go. Whenever we see a gap down in an oversold condition, start looking for a buy signal. See a doji in the oversold area followed by a gap up, that tells you not only was that a day of indecision, but they've told you with great clarity which way they want to now take that trend. After a downtrend, if you see a gap down, watch to see what type of signal it creates. Especially a doji, which tells you the bulls and the bears have found the right level of equilibrium. Watch for the price to change direction. Where do most people sell? They panic sell at the bottom. The one question you always have to ask yourself is everybody's panic selling, who's buying? And you'll discover, if you go back through your charts and you see what signals were at the bottom and the top, that you can calculate that it was the smart money that started coming in when everybody else was selling. A doji in the oversold condition, followed by a gap up, has a high probability of producing a very strong uptrend. A doji in the oversold area followed by a gap up is your best friend. You can make a living just trading off of this signal by itself. Dojis in the oversold area, start looking suspiciously for the buy signal. A gap up and a close above the T line is just further confirmation there's been a change of investor sentiment that's going to provide a good strong uptrend for you. Once again, if one doji means indecision, a series of dojis, 3 stars in the south is what this is called, 3 dojis and then a reversal starting your uptrend, all occurring when your stochastics are down in the oversold area. These signals or patterns or reversals are very easy to scan for on multiple scanning softwares. Just being able to scan for dojis in the oversold area will allow for anticipating or expecting bullish confirmation. If you see a doji in an oversold area and you see a gap up the next day, you want to be a buyer. Not only have they told you there was indecision, but if there was indecision at the bottom of a downtrend, the buyers stepping in are buying with a gap up, telling you that that's great enthusiasm in the oversold area. That's exactly where you want to be buying, is with a candlestick buy signal, gap up, which usually indicates you're going to have a nice strong move after that. Knowing what should occur in the proper conditions of a trend allow candlestick investors to take advantage of a situation immediately where others might need verification that an uptrend reversal has occurred. Candlestick investor can get in very early, which does 2 things. Obviously creates much bigger upside potential. Number 2, keeps you much closer to a situation where if it doesn't work, your stop loss is very small, or your losses from a stop loss are very small. Very simply stated, a Japanese candlestick signal in an oversold condition followed by a gap up is one of your strongest trend reversals. With it gapping up and closing above the T line, also a very strong indication that there's been a change of investor sentiment. What this allows investors to do is, instead of sitting there worrying, oh, I don't want to buy a stock that's already up 3, 5, 7, 10, 15, 20%, if it's occurring in the right conditions with the right signals, you want to be buying early or as fast as possible, even if the stock's up 30%, because that usually indicates there's going to be much more upside to follow. The gap up after a doji is also relevant at major moving averages. This is the area that most money managers are making their decisions. A big down day through a support level, potential support level, doji gap up to it gives you a setup that tells you there's been a change of investor sentiment. It's time to start going long in this position. Once again, it allows the candlestick investor to get into a trade much earlier than others that need further confirmation that a trend reversal has occurred. Candlestick reversal signals such as a doji and a gap up, followed by another gap up, is that much more definitive as far as what the investors are trying to do. They're trying to get into this position very rapidly. Gapping it up tells you that probably the long-term trend is going to be strong. Doji, 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 very convincing confirmation is a close back up above the T-line with stochastics coming up. This tells you there's indecision. This tells you which way they've made their decision. A great benefit of candlestick analysis is if you know the signals and know what should occur or could occur after a signal, you can take advantage of it immediately without having to wait for further confirmation. Does every trade you do in the candlestick universe going to work out? Definitely not, but the probabilities are extremely high that the same reoccurring reactions or investor sentiment thinking is going to occur time after time. And that's what the graphic depiction of the signals and the confirmation is telling you. Not only does it put you in the direction of being in the right trade at the right time, but it also puts you into situations where the probabilities of a big percent move is viable with a much greater probability. And it allows you to be prepared for a potential big move. A series of dojis is a warning there's something major going to happen one way or the other. If you don't have time to sit and watch, you find a spot that tells you that if they bring it up through this level, you'll probably have a breakout. So you put a buy stop right up here at the top of the previous trading. Because we know that out of a series of indecisive trading, a price move is usually going to move in a very dramatic fashion. Take advantage of the information that the charts tell you. A doji, bullish confirmation, especially a gap up, is your best friend. It's usually going to be followed by an extremely strong price move. And the simple logic that is put into candlestick charts allows you to be prepared for a reversal. Where do most people sell? They panic sell at the bottom. If you see a gap down, getting toward the oversold area, and then you start seeing a lot of indecisive trading, start looking for a buy signal. If you see a gap down, you start looking for a buy signal. It prepares you to be able to get into a position immediately. Here we have a doji. That would be on our scanning screens. Next day they see a gap up. You want to be buying immediately. We know where our first resistance level is, right here at the T line. If it shows that it's going through, then you know you're probably eventually in a stage for a very strong uptrend. Putting as many pieces of evidence that there's been a change of investor sentiment together on a chart gives you that much higher probability that you're going to be in the right trade at the right time. A long-legged doji in the oversold area, followed by a bullish engulfing signal, your left-right combination, followed by a gap up on the open the next day, closing through the T-line, just as a very strong indicator you're going to be in an uptrend. And if one doji means indecision, a number of dojis means more indecision. Stochastics in an overbought condition, seeing a series of dojis, followed by a bearish engulfing signal that closes below the T-line, are all indications that the bullish strength has fizzled. The bears are now taking control. And the Japanese rice traders have left us some very simple rules that go with the visual elements of a candlestick signal. A doji at the top, take profits. Dojis at the bottom require bullish confirmation. If one doji means indecision, a number of dojis means greater indecision. and the one that will make us the most money, whether you're day trading, swing trading, or long-term investing, is the trend will usually move in the direction of how they open it after a doji. We've had some smatterings of illustrations on how the doji, and combined with other candlestick signals, can produce very strong reversal situations. One of them is the left-right combination. A doji represents indecision between the bulls and the bears. A bullish engulfing signal is a very strong signal indicating the bulls are taking control. Not in a timid manner. A bullish engulfing signal usually represents a very strong change of investor sentiment. A doji followed by a bullish engulfing signal is called our left-right combination. There's the jab and there's the roundhouse that tells us a definite story of which way the trend is going to go. That information becomes even more significant if you see it occurring right on a major support or resistance level, such as the 50-day moving average. A doji followed by a bullish engulfing signal. Confirm the next day with a close above the T-line. Confirm the next day, gapping up through what appears to be a downtrending channel. Tells us we're in a strong uptrend. A pullback using dojis tells us also a significant story. It's telling us that if these are indecisive trading pulling back, what's that tell us about the conviction of the bears? Not very strong. So you see a doji, a set of dojis on a pullback, start watching for the buying. This tells us that there's profit taking versus real convinced selling occurring. The left-right combination, doji followed by a bearish engulfing signal. Also a very strong sell signal, especially with it confirmed by closing below the T-line the next day. This is not rocket science. This is merely seeing what the Japanese rice traders observed for hundreds of years and told us or presented to us as being strong reversal signals. A relatively indecisive pullback. Doji hammer, followed by a bullish engulfing signal, followed by another strong bullish signal, closing above the T-line. Told us this pullback was not very decisive. This buying told us we were in a very strong uptrend. Doji at the bottom, followed by a bullish engulfing signal. Once again, this is very repetitious observations. Part of the training is to get the eye to recognize these type of combinations. You may not necessarily want to remember each one, but they aren't hard to forget. If part of your profit motive is greed, the more greed you have, the more compelled you're going to be to want to learn these signals to see where the trend reversals occur. And they occur at the bottom of the trends. You can always go back through multiple charts with candlesticks and see what occurred at the tops and bottoms of trends to learn which signals act the strongest and are likely to be seen the most often. Once you become familiar with candlestick signals and where they're most likely to occur, you start getting a much different perspective of how to be investing. Instead of being the exuberant buyer at the top, you're starting to watch sell signals. A gap up doji in the overbought condition doesn't tell you to start buying, it tells you to start watching for a sell signal. Left-right combination starting a long downtrend. As we go through this training, you'll see that the bullish engulfing signal is a strong candlestick signal, and if it occurs right on a major moving average and in the oversold area, the probabilities are extremely strong you're in an uptrend. Your downtrend will stay in progress until you start seeing candlestick buy signals such as the piercing signal and dojis and a move back up above the T line. It doesn't need to be a big powerful signal. It just tells you there's been a change of investor sentiment. A doji followed by a bullish engulfing signal creates that left-right combination that starts you in a good strong uptrend. Although candlestick signals are pretty much recognized for their early warning aspects to show you when a reversal is occurring, they also have elements built into them that shows you what the next price move should be or the next day's trading might be. One of the beneficial price moves that we see in candlesticks that recur quite often is what we call the doji sandwich. A doji sandwich can make day trading very easy, or even swing trading very easy, on the very simple rule of a doji. Here we've seen a bearish engulfing signal followed by a doji. We have one simple rule of a doji. The price will usually move in the direction of how they open it after a doji. Usually after a reversal move and the bulls and the bears are still fighting, if they open it lower, the third day is going to have the same magnitude move as day one. This also gives us a clear message that the T line is not going to act as support anymore. So you can start shorting on this very high probability trade that if it trades lower after a doji, it's going to move in that direction. And then the trend is still going to stay consistent until you see a candlestick buy signal somewhere and a close back up above the T line. A candlestick buy signal, a strong move, a doji. Very simple trade. If it opens positive the next day, the probabilities are very strong that this day is going to have at least the same magnitude move as this day. That's all in conjunction with seeing that your trend is still in an uptrend, stochastic still heading up. Just a very easy trade for a day trader. Doji, doji, doji. Strong price move that confirms a new uptrend. The next day, the bulls and the bears are fighting, residual selling from this downtrend. Very simple trade the next day. If they open up positive, you want to be buying immediately. Will we always get a move of this magnitude? Not necessarily, but the probabilities are pretty strong that you'll get another strong move in the same direction because you're now just coming out of an oversold condition. This is still just a continuation type move with stochastics coming up. Just a common trade. Positive trade, doji, another positive trade. Knowing what should occur after a doji, especially in the beginning of a trend, it allows a candlestick investor to be buying immediately without having to see further confirmation. Just a simple rule that if it opens positive, they're usually going to take it positive at least the same magnitude as this. Very easy analytical process. Bearish harami right here on the T line. Stochastic still in the overbought area, looking like they might start rolling over. The next day we have a doji just underneath it. So we know that we're now below the T line. What do we need to see to continue this uptrend? We need to see how it opens after a doji, which in this uptrend scenario should be that it opens positive and moves higher. On the other hand, if it opens lower, what's that telling us? The T line that has been acting as support is now not support anymore, especially on a doji followed by a gap down. That's our best friend. Down day, doji, gap down tells us we're in a downtrend until we see a candlestick buy signal. That same trade scenario is very simple on this analysis. A piercing signal, which we'll be getting to later in our training, at the same level that it bottomed out before. Then a doji. What do we want to see after a buy signal to confirm an uptrend? We want to see it close above the T line. So we have a doji. The next day they open up positive. What direction does that tell us they're going to move it after a doji? Positive. So we're able to buy with confidence early on that open because we know that they've opened it positive. They should be moving positive, and if they move positive, they're going to close it above the T line. In this case, the T line, the 200, and the 20. So knowing what should happen after a signal or a pattern makes it very easy for the candlestick investor to move aggressively and with confidence, and knowing that there's a high probability they're going to be in the right trade at the right time that will produce hopefully a very strong profit for them. A series of dojis represents indecision. One doji is indecision. A series of dojis is multiple indecision-making days. This becomes valuable information for seeing which way the next price move is going to move. After a great series of indecision, doji, doji, little trading day, doji, 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 all occurring in the oversold area, upon seeing this bullish confirmation, which would be expected after being in the oversold area, and a close above the T line, this not only tells us which direction it's going to go, but after a series of dojis, it usually indicates that the trend is going to be fairly strong. The candlestick investor can see when an uptrend is starting to fizzle. Doji, 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 spinning top, close below the T line. This indecisive trading tells us there's a change of investor sentiment. They are probably going now in the direction of where the latest candle told us they were going, starting to the south side. These series of indecisive trading can be easily scanned. We're looking for dojis in the overbought area. Well, we see the next day there's another doji because we've already seen it on our scan. The next day there's another doji. This allows us to be prepared for a big gap down to this direction, that if we've closed out a position here, we're ready to go short immediately on any weakness. A doji at the end of a flat trading period also has some valuable information. It tells you that if there's going to be a move, we can see it very quickly and get in immediately. Once we see a series of indecisive trading, usually there's going to be a doji at the end of that indecisive trading when you start seeing a powerful move one way or the other. This allows a candlestick investor to start buying even though it might be up, because they can see what happened previously. That this indecisive trading now is sparking the interest of somebody, and that usually tells us that's a prelude to a very much stronger uptrend. It also keeps from deterring from buying on a big price move. A series of indecisive trading ending with a doji and then gapping up. Remember our basic rule, a doji followed by a gap up is your best friend. This allows us to be prepared for a gap one way or the other. As soon as we see this opening stronger, we can be buying immediately, anticipating this is going to be our uptrending results. Another simple pattern is what we call the double doji. Just a very simple consolidation pattern. The double doji consists of a strong move to the upside, then a doji consolidation, and another doji consolidation. What we want to see after the second doji is if they open up positive, usually they're going to have the same magnitude move as the first day. In this case, they did it in 2 days, which helps an investor on timing. If you're buying calls, you can make some very profitable trades by just using these simple setups pull back indecisive, pull back indecisive. The bears can't gain control. The bulls step in and move it up strong again. Dojis, as part of a multi-day signal, are much more compelling than just that multi-day signal not having a doji in it. For example, here we have what is known as a bullish harami, which tells us the selling has stopped. We'll get to this one later in our training. But the fact that the inside trading day was a doji was that much stronger evidence that there was going to be a change of investor sentiment. Or in a morning star signal, if the doji is the indecisive trading day, this becomes much stronger evidence that the uptrend is going to occur, and usually with a little bit stronger force than if this was any other type of indecisive trading day. A powerful aspect of the doji is also involved with what we call the flutter kicker. One of the training sessions that we will be doing is the kicker signal. The kicker signal is the most powerful of all the signals in the candlestick universe. The flutter kicker is a kicker signal that has a doji in between. Essentially, you have a bullish day. The next day, they gap prices down below the open of that previous day, but they do a doji. And we know the simple rule of a doji. The price will move in the direction of how they open it after the doji. If they open it lower, you short immediately because you're going to have the move going in this direction, or essentially, if you remove this doji, you'd have a kicker signal. This allows for the candlestick investor to take advantage of the knowledge built into the candlestick signals, that knowing that the kicker signal is the strongest reversal signal, and instead of chasing while the kicker signal is forming, the candlestick investor can be prepared to immediately short on the open if it opens lower on a bearish kicker, or on if the price opens positive on a bullish kicker. The flutter kicker is essentially a pre-warning that there is a possibility of a very strong reversal based upon the doji forming at the previous day's open, and knowing that the rule of the doji is that they're going to move it in the direction of how they open it the next day. This allows the candlestick investor to get in at the most opportune time on a planned basis instead of chasing after a kicker as is in progress. Basically, the result is going to be that there's going to be a very strong downtrend, and the candlestick investor is going to be able to take advantage of getting in at the most opportune moment. Because of the information built into the indecisive nature of a doji, it is very useful in all aspects of trading. A doji at the top is very simple to analyze what should be done next. A doji at the top with bearish trading the next day indicates to get out of the position immediately. A doji at the bottom. The Japanese rice traders say if you see a doji at the bottom, you still need to see bullish trading to indicate that the weight of the market is not going to continue to push the market down further. Witnessing a doji at the bottom does two things. First of all, it tells you, especially if they gap it down, that you start looking for a buy. A doji tells you there's indecision between the bulls and the bears, especially in the oversold area. You need to see bullish confirmation the next day. Seeing bullish confirmation the next day gives you an extremely high probability that a new uptrend is about ready to start. A doji in between two strong days, or after a strong move, produces the doji sandwich. This makes day trades very simple as well as extending a swing trade. Upon seeing a bullish confirmation or a bullish day, a bullish signal, followed by a doji, with a very simple rule of a doji, if it opens positive the next day, the battle between the bulls and the bears are being seen to have been won by the bulls. You want to be buying immediately. The probabilities, especially with stochastics coming up out of the oversold area, is that you're going to have another very strong day. Witnessing a doji in multi-day signals of a candlestick reversal signal means that reversal is probably going to have a little bit more power to it. An evening star formation with dojis means the reversal, as that signal is confirmed, is probably going to have a very powerful result. A little bit more powerful than if these were just kind of less decisive days up here. That same aspect can be seen in the doji left-right combo. A doji followed by a bullish engulfing signal is a precursor to a very strong price move. The doji also allows a candlestick investor to get into the most powerful signal, the kicker signal, at a very relaxed, appropriate time versus having to chase after it upon seeing the doji or the kicker signal in place or in progress. A bearish candle followed by a gap up doji above the previous day's open. Using the simple rule of a doji, it's going to move in the direction of how they open it, allows the candlestick investor to get into a position immediately with the anticipation that there's going to be a high probability that that is going to form a flutter kicker signal, which the result of that is going to be a very strong price move. This brings us to the end of our doji training. As you can see, the doji has quite a few different aspects to it that allows a candlestick investor to be placing their funds into trades where the probabilities are greatly in their favor. The doji is just one of the 12 major signals that allows for this type of probabilities to be put in place. Please take time and review the other major signals. Once you are finished, you will have a completely different perspective on how to be investing successfully in the markets. Thank you for listening.